Hello, everyone. My name is Brian Overby, and I am the new addition to the Options Play team. My title is Senior Options Strategist, and we're going to take a long walk off of a short pier today and jump right into an advanced strategy known as the butterfly strategy. We're going to look at a lot of different modifications to this butterfly strategy. So if you need to take a break, you need to get some coffee, now's the time. The entire presentation will probably take about 45 minutes, but butterflies are one of my favorite things to do as far as strategies are concerned. And I'm going to talk a little bit about the reasons why today. But to start with here, what we need to let you know that thanks for joining. Options Play Education is totally about empowering you to trade confidently by giving you the tools in order to do that. Now, we also have a disclaimer. Should let you know that everything that we're going to use today isn't meant to be a recommendation, but definitely can use it to learn and format your strategies to fit your outlook. Our agenda is, what is a butterfly? We'll start with that. Then we're going to look at three different strategies: the standard butterfly, the modified, the skip strike, and then talk about some of the best practices that are involved with that. And then we're going to get to answer your questions. Now, in order to answer your questions, it should let you know that there are two boxes. The chat box is only for the moderators and might be disabled. I'm not even 100% sure, but there is a Q&A box, and you will see a little thing that says Q&A with a question mark in it. Load up your questions there. I might not address them right away, but I will try to address them by the end of the event. So if you have the questions, please feel free to put them in that Q&A box. Now, as far as my background is concerned, I am the author of a book called the Options Playbook, where I'm going to actually use a couple of the strategies from inside the Options Playbook to try to help explain what a butterfly is. But then we also have a PowerPoint presentation, and we'll send you that PowerPoint presentation over the weekend via a PDF form. So that will be sent to you at some point in time. You don't see your screen shared. Oh, interesting. All right, Chris, awesome to hear that you have the book. Let me stop sharing. Is everybody seeing my screen? It should be up and running. Yes. All right. We'll settle. The yeses are flying in. Okay, so no problem. Somebody said that right at the beginning, I guess. So here we go. As far as, and let me get, there's the chat. Okay. All right, so thank you, Chris. I'm very glad that you had bought the Options Playbook. So I'm going to switch in between the PowerPoint slides and the Options Playbook, and we're going to have a lot of fun today. I love talking about this strategy, and I think it will come through in my voice as I go through the strategy today. If we go to the next slide here, this is where you get your phone out and you scan our QR code here. This QR code will take you to a place to sign up for a free 2-week trial for OptionsPlay.com. You're going to want to do that. You're going to want to at least give it a chance, check it out. It's a very powerful platform that has a lot of research behind the actual strategies, and including butterflies that we're going to talk about today. All right, so what is a butterfly? We're going to start by looking at a long put butterfly. Now, before I leap into this butterfly, the underlying stock is going to be bookingholdings.com, and I'm going to talk a little bit about that. And the main reason why we're going to use this strategy today on this underlying is because of the value of the underlying stock. And I'm going to get into what's the difference between doing low value stocks and high value stocks. There's some benefits to having a little bit wider spread in your butterfly that a high price stock affords you. So how many people out there, I see a lot of people in that chat box, how many people have actually done a butterfly before, or is this your first time learning about it? And while you do that, I'm actually going to jump into OptionsPlaybook.com. And we're going to start by just looking at a butterfly with puts. Now, the reason why I'm going to talk about puts is we're in September and October. And because of that, all right, so we got about 50-50 from what I'm seeing inside the chat there. So we got about 50-50. So that's excellent. That's excellent to know. We got a fairly advanced crowd here. When we look at a long butterfly with puts, I'm going to focus on the put side of thing because in general, the market obviously got some good news yesterday. I guess it was interpreted as good news. It's hard to say by the actual reaction, but the Fed came out and said they're going to lower the Fed funds rate by 50 basis points, where it was anticipated, well, by the time it got to the actual meeting, it was about a 50-50 chance that they might go 25 basis points or 50 basis points. So the market has taken that as a positive, but we're in September and October. So here's part of the reason why I'm jumping right in and talking about long put butterflies is if I'm bearish on the marketplace, I like to use this strategy. And there's a modification that we can do to the strategy. And when I come back, I'm actually going to talk, that next presentation that I do here at Options Play is actually going to be about how we could modify the strategy if it's gone against you. But we need to walk before we run. So let's start by just looking at what the put butterfly is. And this goes hand in hand with the call. Everything that I talk about today can be transferred to a call butterfly. There's really not much difference. But if we have a stock, the way the Options Playbook is laid out, and this is the book that I've authored, is we talk about a put butterfly being at the money, the underlying stock being right here at strike B. We're going to target this. In our examples, we're going to have the stock up here by strike C, somewhere in this range, because we're going to be bearish, and that's part of the reason why we're going to use puts. But in this example, we're talking about the stock being right here, right at strike B. And if you put on the put butterfly, what you're really doing is you're combining two different strategies. So if you've done a long put spread, or if you've done a short put spread, you've done a butterfly. But the biggest difference is you actually have to put those two trades together to come up with the butterfly. So here's the standard setup for a butterfly. You're going to buy a put at strike A, and then you're going to sell two puts at strike B, this middle strike in our example, and then you're going to buy a put at strike C. Now, like I said, this says the stock is generally at strike B. We're going to have the stock somewhere up here in this range when we're looking at our examples. So let me go back and actually show you what I meant when I say if you've done a long put spread and you've done a short put spread, you've actually done a butterfly if you combine them all into one trade. So here is a short put spread right here. So if I do the short put spread, we have limited and known risk if the market goes down, and we have limited and known upside if the market goes up. So we do it for a net credit to the account. We're selling this put here. We're buying this put for protection, and we want the market to drift upwards, or if it's up here, just stay where it's at. We want time decay to be our friend. Now, if we do a long put spread, and let me grab that strategy. I guess I had the wrong one out here. So if we had the long put spread, and let me get the graphic done, then in this instance, we are paying a net debit for the trade. And what we want with that net debit, that gives us a limited and known risk if the market goes up. We are profitable between the strikes, right in this range. This is where our break even is at. And then if the market goes down, we can make the maximum on our trade. So let's flip back and forth fairly quickly here, right? We have the short put spread. We have the long put spread. Let's slide this up a little bit. And you can see that if we do this kind of quickly, back and forth, we do this little dance, long put, short put, long put, short put, and we combine them both, and guess what? It looks like this. It looks like a long put butterfly spread. So ideally on the long put spread, the fact that we're going to have our short put spread that is bullish on this side of it removes this unlimited profitability as the underlying goes down. And in this instance, the fact that we have limited and known risk here, but we have a limited and known profitability on the upside if it goes up, is offset by this side on this trade. So this line goes away. And what ends up happening is we sell 2 at strike B. So we're selling this put on the short spread and we're selling this put on the long spread. And this ends up looking like our butterfly. Now, the one thing that's wonderful about a butterfly is, especially if you're in an expensive underlying, they're usually done quite cheap. And that is a beautiful thing. The non-beautiful thing about a butterfly is that you need time decay to happen in order to get the maximum profitability on your trade. Because here's the issue with a butterfly, if I put this trade on, because the profit and loss graph at expiration looks wonderful. But if you put this trade on and the market comes down to strike B and say you have a lot of time value, or there's a lot of time left in your option contracts, you've gone out, let's say 30 days, and you're right on your forecast right away, it comes to strike B, you're short 2 options right at strike B. You're short these 2 puts at strike B. And guess what has to happen? You have to buy those back. Would you like to pay the maximum premium? You just put the trade on, or would you rather do it closer to expiration? And the answer is closer to expiration. So you cannot max out on your butterfly until you get some time decay on strike B. And I'm going to modify some of these butterflies, and that's what I really like to do. But a very popular trade to do in the 0 DTE scenario is to go in an expensive underlying and buy one butterfly right at the money and hope that the market just kind of stays there. And at expiration, you're from the beginning. So for example, an underlying like the S&P 500 index, you have a lot of value in your option contracts on with only 1 day remaining. The time decay doesn't even start really eroding until you get closer and closer to the actual expiration. I would say on Eastern time standards, it's between noon and the expiration date. So you're trying to take advantage of this scenario where butterflies are cheap when there's a lot of time premium, and you know that the time premium has to go away. And that's one of the things that 0 DTE or daily option contracts can help you with. So are there any questions in general about the butterfly? Because so now I'm seeing that screen share isn't working. Is that true? Okay, so some people are having issues and others aren't. So that's kind of a situation. Okay, it says working in general. Okay, so the general consensus is that it's working. So if you're having some issues, it must be on your end a little bit. Okay, here we go. So I'm going to go back, and so everything that I just kind of talked about is true when we look at a high price underlying like booking holdings, which is the old price line. I'm going to grab this and we're going to go to presentation, where we have a $4,000 price on an actual stock. So in this scenario, we're going to look at the September 28th expiration, which is 8 days away. We're going to get bearish. That's why we're going to use puts. If I want to be bullish with my butterfly, I would go to the opposite side of where the underlying stock is at, and I would use calls. So in this situation, we're going to go 8 days away. And if we look at this scenario here, here is the profit and loss graph that you were just looking at inside the Options Playbook. And we're right here, right about where strike C is at. If you notice here, our underlying stock is at 4,047. And that would be right here. The put that we're buying is going to be 4 points below at the 40-40 strike put. And we're going to sell 2 of the 40-20 strike puts and then go down and buy the 4,000 put. Now, this is one of the things that's wonderful about a butterfly in an underlying like this is that if you actually we want the market to go to 40-20, right? If we bought that put outright, that would cost us $34 for 8 days of time premium. We still want the market to go to that level, but if it goes to that level, we can make $20 on our trade minus $225. So now, instead of having all that risk of paying for this option contract at $34, our total risk, if we do the 1x2x1 butterfly, which we're going to send to the trading floor all as one trade, is going to be the net debit paid for this butterfly, or this is real markets using today's numbers, that was trading at $2.25 at the midpoint today. So $225 is our max risk. Our max profit would be 20 minus that 225, or 1775, or $1,775. Now, okay, are you in your seat? Are you ready? I got to tell you something though. If you do make the maximum profit on a butterfly, you should receive the stupid award. You want to know why? Because you should have been out way before that expiration. If you get a situation where you're approaching the expiration date and the underlying stock comes down and hits your strike price and you are profitable on your trade, you should get out. So the only way that you're going to make the maximum on your trade is if you pay $0 for this $34 put option, and the only time you're going to do that is at expiration if it's right at your strike price. So once again, if I'm doing this trade, I want to dampen expectations. The profit and loss graph at expiration looks wonderful. And one of the things that I do really love about the butterfly is that this small little area, and I'm mousing on it right now, that's your maximum risk. Very little risk on the trade. That would be $2.25 above strike A or strike C and below strike A. Also on this butterfly, when you're using higher price stocks, you see that here's the actual range that the underlying can land in. It's a $35.50 range. So how do we come up with that? You actually take the strike price of the 440 put minus the net debit paid. So our break-even point on our profit and loss graph right here is going to be $4,037.75. On this one, it's going to be $4,002.25, which is this strike plus this premium. So in general, if you look at a put butterfly and you're doing it in a fairly high priced underlying, it's a very enticing trade from just looking at the profit and loss graph at expiration. But we need to dampen our expectations in that if I do this for $2.25 and I can double on the trade, let's say I can even do more. Let's say I can sell it for $5 to make the math simple. If I can sell it for $5, that's a good trade. And you should have your goals set and your expectations set that if I do double on the trade, I'm going to get out of that trade. I'm not going to hang around and try to get the maximum on the trade. So you have limited and known risk, but in order to make the maximum, as opposed to buying a put outright, right? If the market goes down, you want to get out right away on that trade. The maximum only occurs when you get closer to that expiration date. Okay, so with my butterflies, if I'm doubling on them, I'm usually going to get out of that trade. It's that simple, that straightforward. But here's the catch with me doing butterflies. Very rarely do I just do a put butterfly and do it in a standard manner, for lack of a better term. I call this a standard butterfly, but there's no rationale why this is standard except for the fact that this is the one that most people talk about all the time. The two other butterflies that I'm going to look at, I'm going to modify them, and I'm going to mess with the risk and the reward of the trade. So yeah, and people are already thinking about it. One of them is a broken wing, and I don't like the term broken wing, and I'll get into why I don't like the term broken wing. But I'm going to address some of those questions. So there's a lot of questions that are coming in just on butterflies. So let me pull them over here. Let me look at them and try to answer a few of them. People are guessing what the next strategies are. Nobody's actually guessing the secret strategy that I have planned out for you. Vance is saying the first leg is in the money to start. Well, in this instance, it's not, Lance. And here's the thing. We're talking about puts. So we're just out of the money, and that's always tough when you're trying to explain a new strategy on the put side of things. But my plan going forward is to use a lot more butterflies, and inside the Options Play platform, if you do sign up for the free trial, we do have what we call a daily play. And I'm doing the daily play. I'm taking over a lot of that expectations. Tony Zhang, the CEO of Options Play, is also going to jump in from time to time. But one of the strategies that I want to be able to do are butterflies. And so that's part of the reason why I picked this topic as my first topic for Options Play. So the issue here is that over the next couple of months, I'm going to look for times where I can get bearish. All the way up until, and this I'll just give you a little bit, I guess we'll digress a little bit, but my attitude on the marketplace is, even though we had the cutting of rates, that usually when you get into the end of October and we got that big event in November, the presidential election, all the way up until that date, I'm going to lean to the bearish side of things, and I'm going to look for trades in underlying stocks that I'm willing to get bearish on. So that's the reason why I'm looking at that. Okay, so the first leg is actually out of the money to start. So let's talk about that. If we're at strike C, and you notice as we go further down the chain, the options become cheaper. So that's your first hint that we're out of the money. The stock is trading right around here. It's actually 7 points higher than strike C. So if you look at my mouse, this is actually where that stock is trading at. And then as you go down, you get further and further out of the money. So we're looking for a little bit more of a move to the downside. And this is normally how I would set them up. Within a one standard deviation move, basically something that's not that far away from the actual underlying stock, that is where I'm going to target with my butterfly. And the fact that this is a higher price stock, and we got a $35.50 landing place, basically between these strikes. And that's what this is showing over here on this side. All right, so anything else? Okay, that was the first leg was in the money. Your example is B where you expect it to go. Yes, B is where I want it to go. I'm not, yeah, I guess you could say expect it to go, but I prefer that it lands on strike B, and I'd rather have it happen closer to the expiration date. I do that little quip about about getting the stupid award, but I mean that's true. It's just a funny way to say that you should stick to your plan when you're doing any type of trades in options. And if you stick along in a butterfly too long, it can obviously take off in a hurry and be gone before you know it. And a profitable trade becomes an unprofitable trade in a hurry. So the only time, and I guess I'll put a little bit of a qualification on this. I do a lot of butterflies in my own account. And if I'm doing a 5 lot or a 10 lot, and the market comes down and I can double on this, say I could sell this for $5 to use our example to start with, I might sell half of the position. Every single day that goes by, and I'm always using the shorter term expirations on these butterflies. I talked about 0 DTE already. This one's only 8 days away. And that's part of the reason why we're going 8 days away, is because we're going to be able to modify this trade if we do this butterfly. And we're going to talk about that on the next event. So make sure you sign up for that now. Or as soon as you get the email. It's actually not sent out yet, but make sure you want to, because that's going to give you the adjustment to the trade. Everybody knows what to do when the market goes with you, right? It's really hard to figure out what to do when it goes against you. So to not digress too much, if I do have a 5 lot on, I don't mind selling 3 of them and keeping 2 alive, or selling 4 and keeping 1 alive. I have had butterflies land right on the strike, but it's usually by that point in time I only got 1 butterfly left. 1 unit is the best way to say it. 1 by 2 by 1 butterfly. That's the ratio. Okay, yes, we want it to go to strike B. See anything else in here that's kind of dealing with butterflies? And let me see. Let me check out the question area. Okay, I tried using stops in the brokerage platform, and my butterfly trades, but weirdly it gets stopped out randomly. I use the stop on the option price. Should I be using the stock price to trigger the stop? Can you touch on this? Okay. Well, part of that, it would be the brokerage firm is who you'd want to talk with. If you're doing a stop, that means that you want the market, if the market's going up or going down, you want to get out. Are you using the stop for protection? Would be my next question. Here's the thing about the stop order is if I do a stop based off of the stock price, I don't know what the butterfly is trading at. And with butterflies, especially in a market like Booking Holdings or any big price stock, the bid and ask are a little bit scary the bigger the underlying value is. So when that happens, I don't want to do it off of the stock price, Colin. I want to do it on the price of the butterfly, and I want to send it to the floor at the midpoint. And at that point in time, you get the alert, and you can go in and adjust your trade accordingly if it's not getting filled. So I'm going to leave that there, and that's a question for your broker on how to execute that. So in short, I don't want to use the stock price. All right. There are some things, some people are saying the success rate, the probability of success is going to be lower on a butterfly in general because you need it to stay within a range. We're going to adjust that probability of success. Anonymous attendee, to answer that question. 8 business days or calendar days? It's always calendar days. I always talk about calendar days, so it's going to include this weekend. So we're going Friday to Friday, basically, in this trade. All right. I use the stop for protection. Okay, that means that you're outside of the strike prices. Well, in a butterfly, one of the things that I kind of look at, first of all, so the stop is trying to be used for protection. How much are you paying for them? When I look at a butterfly, I'll adjust the butterfly once. I'll make one adjustment, especially on these shorter term ones, like 8 days away, like all my examples that I'm going to use today. But with the butterfly, if the market's going against me, I don't think I'm really going to stop myself out. I'm just going to kind of let that ride, knowing that the fact that I'm doing a butterfly for $2.25 doesn't really scare me. I know that that's the max risk, but I've never personally used a stop order to protect myself if the market goes against me. But still, everything else that we talked about, Colin, applies. All right, so now these strategies are getting into something at the end of the strategy, and I'll try to address some of those in the Q&A. If you have questions that you want addressed at the end, put them in the Q&A instead of the chat, because I'm digressing here. I'm trying to make this 45 minutes, but you know what? If we go long, we go long. I like talking about butterflies, not that big of a deal. As long as you want to hang with me, I'm willing to hang with you. That's simple. All right, so hold your hats. Nobody guessed the next strategy that we're going to show, and it may be new. I call it a modified butterfly, and this truly is a modified butterfly. And I actually don't have this strategy in my book. So there's 40 different strategies, and I have about 6 different types of butterflies and outlooks and strategies and modified but this one in particular isn't in there. So I went into the OptionsPlay software and doctored up a profit and loss graph to try to help us understand this trade. So we're going to use the same examples on that butterfly. The market's at 4,047. We're buying the 440 put, selling 2 of the 420 puts, but you notice this one's in red. On the other slide, we had that put at 4,000. Now that put is at 4,005. We went up 5 points. So let's think about this. Our long put spread is still the same amount. It's still 20 points. Our max upside is given and provided to us by the long put spread. But the short put spread is not as wide. It's only 15 points wide. So what does that mean about the short put spread? See if we get that answered. All of a sudden, the chat box went quiet. So it looks like I was able to stump the crowd. I'm all right with that. If the short put spread is smaller in width, it's going to bring in less of a credit. And here's the beautiful thing about a butterfly. If you just sit and you think about them, what you're really trying to do, and think about how we started this presentation looking at the butterfly inside the options playbook, is you are really selling a put spread trying to pay for a long spread. That's what a butterfly is. You sell a put spread to try to pay for a long spread. And you're further out of the money with the put spread, so you're never, in theory, going to be able to pay for it. But you can greatly reduce the cost. So when we sell our put spread here and we don't bring in as much of a credit, guess what? We're going to have more cost. So I'm going to jump back to the slide before. Our cost was $2.25. And you can decide for yourself if this trade-off is worth doing. If we go to the next one and we jump to this one, it's $3.50. So $2.25, $3.50. You're talking about $1.25 difference, $125 for each butterfly that we put on in BKNG. That's the difference. Now, this is a little different. I apologize for the graph. That I don't have a graph inside the options playbook, I guess, would be what I'm apologizing for. But here is where the underlying stock is at. So I put this in the Options Play software, and I use the profit and loss graph here. So we're paying a little bit more. This area right here is $3.50. $3.50 here. If we go back to here, $2.25 here. But the short spread, since we're paying more, gives us a benefit if the market tanks on us. So if we go down and we blow through this strike and continue on down, the fact that this is 5 points less than our other standard butterfly means we get $5 at the end in our butterfly. It's going to be worth $5 if we went to sell it with no time premium left in this option contract, but we paid more. So we paid $3.50, and this actually would be green all the way down because we're profitable all the way down on this trade. From this point, from our 440 strike, all the way down to 0, we would be profitable on this butterfly. The cost savings is there, right? And the cost savings might be there if you're talking about doing just a standard long put spread. It just wouldn't be as amazing of a cost savings as it is with the modified butterfly. But we paid $3.50. So 5 minus $3.50 means that from here on down, we'd be making $1.50. From here on down, we'd be losing $2.25. lose 225, lose 225, lose 350, make 150. Did I get your attention? So this is just a different way, and I think of this as a truly modified butterfly. I hate modified butterfly for what I call a skip strike butterfly inside the options playbook, because to me, a skip strike butterfly is more of a credit spread than it is a butterfly, and that's the way that I approach those trades. But there's different times where they make sense. If I was going to get bearish on booking holdings, we can still adjust this trade, and that my adjustment would work in this underlying. I personally would be more apt to pay more upfront to have the possibility of making money anywhere below our protective strike of 4,005. So let's go through the numbers. The max risk is $350 or $350 for every 1x2x1 butterfly that we put on. The max profit is 20 minus 350 or 1650. It's a little bit less than our other one because we paid more for it up front, or $1,650. And remember, if you make that, you get the stupid award for that. The break-even point is only one of them. If you go back to this slide, we have two break-even points. We got one here and you got one here. On this slide, we have one break-even point, which ends up being right here. So the underlying stock is actually, this is off a little bit. It should be right about here, where the underlying, just up just a smidge from where this line is showing. All right, and then that would mean this is where we're going to break even. We need the market to come down at an expiration to 440 minus 440 minus the 350, or 4,036.50. That's where this point would be on the break even. All right. Any questions on that one? How does this affect margin? That is a great question, Ken. The same way the regular butterfly does, or the standard butterfly, for lack of a way to say it, right? So standard, I guess I should go in this slide and maybe make it say standard butterfly, but yeah, it's the exact same thing, because if you look at this, there's no unlimited risk. There's no additional risk that's been added to the trade. The additional risk comes up front in the cost. So you're paying, and this is normally the case, it's fractional, the amount of difference, and it depends on the underlying. Everything depends on the underlying, depends on implied volatility, everything to go with it. But you're paying $2.25 here, and to remove that risk on the downside, you got to pay $3.50. So you're talking about $1.25 to be profitable for anywhere on down. So that's how it affects the margin. It's $1.25 more to put on the trade, but the max risk is the net debit paid. All right, I'm getting some good stuff. How about define the width of the wings? How to define the width of the wings? Well, here this width. This is the long put spread, and the long put spread drives your profitability. It's what gives you that profit. So in this instance, from 440 to 220, that's 20 points wide. That's our long put spread. We bought one of these and we sold one of these. So our width, so that means that our max profit stays the same, except for the fact we paid a little bit more. So our max profit actually is, to be exact, is $16.50 versus $17.75. All right. Besides a neutral strategy, a butterfly can also be a directional, correct? I prefer to do them directional, honestly. So Kim asks, besides a neutral strategy, a butterfly can be a directional, correct? I've seen people use the weeklies with a high probability in a move in a short length of time. Yes. So go all the way back to the beginning of the seminar. And what I said is, one of the more popular things, and this is why butterflies are being talked about more, is you need time decay in order for, if you're right on your forecast, in order to get paid a decent amount in your butterfly. So you want to dampen expectations, like especially like with 8 days away. If this stock goes down to this level and hits this strike right at strike B, you're going to be sad because you're going to be like, what? I made $1. What are you talking about? And you're going to hang around, and before you know it, it blows through strike A and you end up losing everything because you were frustrated that you only made $1. And that's only because you didn't have a realistic expectation on your butterfly. So I'm trying to give you that realistic expectation today. All right. So Let's go back to zero DTE. A lot of ETFs and a lot of indexes, including the SPYs and SPX and I don't know how many ETFs actually are trading zero DTE options contracts. But you put it on in the morning, especially if it is a high value underlying, and you take it off in the close. And you just hope that the market stays within a range. So some people will say, well, on Mondays, they're the biggest movers. I don't want to do it on a Monday, but now I can do it on a Tuesday. Prior to the Fed meeting, maybe that was a good trade to do. Think of it that way, because you knew that the market would, and it did. It actually should have panned out. I think the market was kind of mediocre on Tuesday ahead of that Fed meeting. So that would have maybe been a solid standard butterfly to do and a standard situation to do that. And by the way, that's what the daily play is all about. Everybody can look at a profit and loss graph and say, wow, that's an interesting strategy. But understanding the underlyings that you might want to trade that's what Options Play is all about, and that's what our daily play portfolio that we put together is about, trying to explain why we want to do this strategy and this underlying, and what are the benefits of it. Okay. Excellent. I think I addressed most of the questions. If I didn't address a question and you're sad that I missed it, go ahead and put it back into the Q&A box, and I will try to answer it there. Oh my gosh, and now I just scrolled down in the Q&A box. All right. When do we exit a butterfly? When do we exit like 50% profit of the cost of the trade, or mainly wait for the stock to come close enough to the long strike? Okay. If I'm exiting a butterfly, if I can double, that's what my goal is. If I put it on for 225 and I can sell it for 450, that's a really good, solid butterfly trade in my mind. You might shoot for a little bit less. It really depends a little bit on that underlying, but that is usually my goal. Now, if it hits a strike or whatever, yes, if this stock came all the way down from strike C and was sitting on strike A, I'd get out of the butterfly, just because you're right. If it continues on down and I have a standard butterfly on, I'm nervous and I already missed my chance. So I would definitely think about getting out. So there are little nuances of butterflies that if you trade a lot of them, that you just kind of realize, well, I screwed up. I didn't get out when I was profitable on the trade, and now I have a situation. How many, okay, so let's go back. I think that answers the butterfly, 50% of the cost. Oh yeah, so on the risk, like I said, if I'm doing a butterfly, I'm gonna give you an adjustment on the trade, but I'm getting it done for such an inexpensive cost that I'm managing my risk by the number of butterflies I'm doing, right? So I gotta be prepared to lose that entire amount if I'm doing the butterfly. So as opposed to, like, I think if you're saying managing, let's say we bought the put, right? If we buy this put in Booking Holdings, this is ridiculous, and I don't think anybody would just buy a put outright. Well, I don't want to speak for everybody out in the world, but most people wouldn't want to pay $42 for an 8-day option contract, $4,200. But I'm going to manage the risk if I do, right? I am definitely going to manage that risk. And I might say if I'm down $5, I'm out. I'm not even going to say half the cost on that. A butterfly, I'm managing the risk by putting the strategy together just to start with. Just that simple. Okay. Can you use darker pointer? I tried to do the darker pointer. I apologize. I couldn't pull it off right before the strategy. Like I said, this is my first rodeo with Options Place. So I don't usually use Zoom. So this is my first time doing it. Theta and Delta, I'm not shooting for those. Okay. So I'm not really looking at the Greeks in this scenario. Once again, it's the strategy that I'm looking at. And I guess if you say theta, I would not, I'll address theta this way. I would not want to go out 16 days on Booking Holdings. I would not want to go out 16 days. As a matter of fact, I'm doing a 1-week option contract in our examples when, they're not meant to be recommendations, but I put the slide together today. I would prefer to do this on Monday, but I don't know what the quotes are going to be on Monday, right? But I would rather do this literally let the market open on Monday, see where it's at, and then put on the trade. And then you don't have that gap over the weekend and you have 5 trading days. And if the market does go down within those 5 days, I should be profitable on the trade. If the market actually went down and I had, let's say, 16 days, double the number of days, I might be just a little bit profitable on the trade, right? So I'm managing it by the days to expiration. And so there isn't a magical theta number, especially because it really depends on the underlying that you're looking at. But days to expiration, you have to think about a lot if you're going to make this a standard trade. Okay. So the difference between the strikes. So I'll address that at the end. Okay, remind me at the end, everybody, because picking the strikes are very important when it comes to a butterfly. All right, you ready for the last butterfly? All right, here we go. Boom. Skip strike butterfly, which everybody guessed. A lot of people call it a broken wing, and other people call it a modified butterfly. This is inside the Options Playbook, and I actually have updated this graph, so this is actually an animated graph inside the Options Playbook. That's why it looks a little different than the first one. But with that said, what you're doing now is you are buying strike C, selling 2 of strike B, and skipping strike A, and then buying strike minus A. So I guess we should have started with strike D. But bottom line is, the standard butterfly, you buy, sell 2, buy 1. We're going to skip this strike. And guess what happens when we skip that strike? We actually embed a credit spread inside our butterfly. And by doing the skip strike butterfly, we are hoping that that credit is a big enough credit to pay for the butterfly. So if you do the skip strike butterfly from this strike to this strike, the width of that strike, which in our instance would be 20 points, if you're doing it like a quote unquote a balanced skip strike butterfly, where this is 20 points, this would be 40 points. You can modify that a little bit. If you want to only make this 35 points wide, that's fine. You just don't pull in as big of a net credit to the account, but you're going to have a little bit less risk. So if I did a short spread and I sold strike A and sold this strike and bought this strike, in this instance, if I sold the 4,000 strike and bought the 3980 strike, if I did that, I would have a 20-point wide short spread. I would bring in more of a net credit than I received for this, right? I'm going to bring in more of a net credit for that. But my brokerage firm is going to require me to hold out $2,000, the width between the strikes, minus the net credit received. And in our butterfly, that is also the case. So you're going to have $1,500 worth of risk in this trade. So if I'm doing a skip strike butterfly, I'm going to take less of a credit. $5 is a fairly big credit here, and I'm going to go down in strike. I kept the strikes the same here just because I want to compare apples with apples. And we started at the 440 strike, but I would push this down and maybe start at the 420 strike and say, okay, if you're going to hit my pain point, you're going to have to make a large move, and to use a term that I haven't defined yet, one standard deviation move or more in order to hit the maximum risk on this trade. So I would be doing this for less of a credit and I would slide it down. Nonetheless, I like skip strike butterflies in certain situations. It's fun to do a butterfly and actually get paid for doing it. So inside the playbook, I actually kind of struggled with this because I didn't really know what to call it. Do you say this is a long skip strike butterfly? So I just put skip strike butterfly. Honestly, I just finally gave up and said, I'm just going to call it a skip strike butterfly because there's no real reason why this is considered long. Usually a butterfly is considered long only because you're paying a net debit for it, and we're not paying a net debit for it anymore. All right. So let me talk a little bit about the max risk and these type of things on the skip strike butterfly. The max risk is you have 20 minus 5 or $15 or $1,500. That's going to be a margin requirement. It has to come all the way down to this level in order for that max risk to hit. The max profit would be 20 plus $5. In this instance, that means it goes straight to this strike. We still have our long put spread driving the maximum upside from 440 down to 220. And we're bringing in a $5 credit. So we actually, a home run in this situation would be that $5 credit plus $20. Or in this instance would be $25. I don't know, I got the wrong number here. So it would be $2,500 in this scenario. But our break even is actually determined by the strike that we skip. The strike that we skip here. And it's that minus the net credit received. So we skipped the 4,000 strikes. So this would be 3095. Wow, I really screwed this one up. Don't look at my math. Good thing I have a degree in math, but I'm going to have to clean those slides up a little bit. And I'm seeing a lot more questions come in. God, we got a very inquisitive crowd today, that's for sure. So if I'm looking at this trade, and I'm doing this, now let me go all the way back to where I began with the skip strike butterfly. If you are a short spread trader, you like to sell call spreads, you like to sell put spreads. Let's say we're going out of the money. We're going to if we got a 5-point wide call spread and we sell it for $1, we should have an 80% probability of success from doing the trade. It's just the way options are priced and the overall risk. If they're priced correctly, it should be about an 80% probability of success on that trade. If I do that trade and the market goes against me, when do I get out? Do I get out when it gets halfway there? Do I get out when it gets to the strike? Do I get out when it doubles, when it goes to $2, right? Is that when I get out of the trade? Well, as soon as it starts going against you, you got to start thinking about that if you're doing just a standard, we'll call it a short credit spread. We sold 5 points wide, we brought in $1, okay? What if you could do a skip strike butterfly, sell that same credit spread, take that credit and pay for a butterfly, right? Now remember, that means you would be buying the one that you sold and you would be selling the one that you sold because you're selling the strike. So that's really what you're doing. You're really just maxing those two out. And if you do that, now if the market goes against me, oh well, that's okay. As long as it doesn't go against me too quickly, as long as it doesn't move too fast. But would you think of it this way? And this is a possible scenario. We show how cheap butterflies are. So instead of selling that credit spread and bringing in $1, what if you could sell that skip strike butterfly and bring in 50 cents? But your hedge is already there. Right? If the market goes against you, the hedge is already there. You've already put it into your trade. Makes you sleep a little better at night. Now, it's an odd trade in that it's going to hurt you if it moves really fast. So once again, just like all butterflies, days to expiration is a big deal. And you're picking the days to expiration here you're looking at it much differently because you want to go out far enough that you can bring in a big enough of a credit because you're going to use some of it to pay for your butterfly. That simple. All right. And you can do it on both sides. So I don't like to think of a skip strike butterfly as modifying a butterfly. I'm modifying a short spread. And if you were ever looking at volatile underlyings where you are worried about that movement. You're trying to sell some premium and you see a lot of premium. So I want to sell this. Well, give up some of that premium and actually do the butterfly. And it's actually not a bad adjustment. And if you did a butterfly in a way and you put it on at a later date it's a little tough, but you could say, well, I paid $1 for it, and all of a sudden that butterfly that I would have done in the skip strike is now trading for $1. Okay, I'm going to do it. I don't want the cheese anymore. Just let me out of the trap. And I take the credit and pay for the butterfly. And it gives me a chip in a chair. It's just that simple. I still have the risk of the short spread, but it does give me an out if the market keeps coming up towards my middle strike. So that's an interesting way. Now, that's one of the modifications that we'll talk about when we're looking at it. So think of it that way. 440, 420, 410 is still skip strike butterfly. No, it's not a skip strike butterfly. I'm going to argue with that. Panthea. It's not a skip strike. That's modified in that we aren't skipping that strike. The 440, 420, 410, that to me is a truly modified butterfly. Now, and it's just semantics. But if I do that, that's not a skip strike because we're stopping short on our butterfly. We're stopping short on our standard butterfly and we're paying for it. So this to me deserves the term modified. And maybe you could say broken wing because you're still broken. So maybe those names, which I've never liked, you could, I've always called this a modified butterfly. Let's just leave it there. Okay, and then I'm confused. How do butterflies make profit? Well, they make profit if you hit your short strike here. So yeah, there is, if I put this trade on, well, we're talking about puts, so it's actually got a negative delta. You want the market to go down, but that's once again semantics too, is that it will be a positive delta. Well, it will want the market to go down and the delta will be showing you that you want the market to go down. It's hard to talk about put deltas because they're negative, but in this instance, you will want the market to go down, and it is delta. So another way to say it is, yes, price will drive profitability. Instead of saying delta will drive profitability, price will drive profitability. If it goes down, in this instance, strike C will become in the money and will reward you more than strike B is hurting you against you in that trade. And I'll talk a little bit about that. I hope that helps with one of the questions I see in there. Can you please go to the live platform and select the strikes for your fly? Okay, if it's at 40.1751 now, the market's closed, we can maybe go and look at that. Well, I still would go 20 points wide. And I'll talk a little bit about the width of the strikes and why I like higher priced underlyings. If you don't use the Greeks, what criteria do you use to set your strikes? The criteria would be based off of the percentage, all right? So if we're going 20 points wide, and you can look at it this way, divided by 47, right? You're talking about 5%. 20 points is 5% of the underlying stock price. And that would be the way that I would approach my butterflies. I would look at the underlying price. I want to make it wide enough that, and I guess we keep going down this road, so I'll address it. I was going to address it at the end of the show. But I want to be wide enough that in this instance, and this kind of happens in the SPY a little bit, just other little things, but so I guess I'll do an example that way. But if I get to the 440 strike, if I come down 7 points, which isn't a very high percentage move in BKNG, if I get down to 40.40, what I ideally want is this option contract to have a lot of juice and these option contracts to start withering away. And by being 20 points wide or 5% of the stock price, that can happen, right? And so in this instance, that's why I chose to go 20 points wide. I wanted to make it a decent debit that if I lose it all, I'm not going to cry on my pillow. So I want to go wide enough that I get this benefit that if I do hit this short strike, that these are far enough away that I'm going to get enough time decay in these option contracts with only 8 days away to start making this trade profitable. but I also don't want to pay too much. So if I go 30 points wide, wow, that's even better as far as time decay is concerned. But now I got to pay $3.50, $4. All right, does that make sense? So there's a magical number that you really want to try to come up with, and it's the width of the strikes. Okay, so here's the situation. If you're looking at the SPX and the SPY, and I get this question a lot with those two underlyings, is the SPY is 10 points, 10 times the SPY equals the SPX. In theory, it doesn't always work out exactly that way, but in theory, that's the concept. But a 20-point wide butterfly in the SPX is only a 2-point wide butterfly in the SPY. So if it comes down and it hits your strike and you get the same type of movement that you would in the SPX, gosh, you're only 2 points away on your short strike, and time decay is going to act differently. That's the main reason why I like to do it in more expensive underlyings, right? It's just the way options are priced react differently on lower price underlyings as opposed to higher price. And there's also truth with volatility. If I'm doing a lower price underlying, I might want more volatility. Just did quite a few in the VIX. When the VIX ran up to 60 and came back down, did the actual modified butterfly on the downside. And in my mind, that was a great trade. The VIX was sitting right around 28, 29 and hanging there. I did this butterfly that would be profitable, centered it around the 25 strike. That was a great example. Low price underlying, but the volatility is through the roof, right? The VIX of the VIX tracks the actual volatility in the VIX option contracts. So that was a great scenario. Going into September, right? I did it the opposite way. Took this butterfly, flipped the script, and used call options and targeted a increase in implied volatility. And that's all just because of the seasonality of the marketplace going into September and October. All right. So that's an extensive conversation that I love this crowd, because I hope I'm not talking too much over people's head in general. Still getting a lot of questions. Okay, so how far away from the underlying market? Okay, so for example, now the question's kind of, I think, if I'm reading this right, Chuck, like, why did I do the 440 strike? I just want my butterfly to be within a decent range. I don't want to go one standard deviation away in my modified butterfly or my standard butterfly. I want it to be within a range that could happen, right? And if you target a downside one, your butterfly becomes cheaper and you target a price. If you target an upside one and you use calls, if you go out a little bit out of the money, you're going to get cheaper than buying that at the money butterfly. It's that simple. So by targeting one to the downside or the upside, but I don't need to get crazy with it. I don't need to get that huge move in order for it to pan out on those butterflies. Now, obviously, I'm billing this one as literally a short spread. The skip strike butterfly is a short spread, right? That's a short spread to me. It's not a butterfly. And I'm using the short spread, the credit from it, to pay for the butterfly. So I'm going to go further out of the money because I got all this risk. If the market starts plummeting, I have all this risk in this range. So I want that range to be way out if I'm going to do that type of trade. All right. I hope I answered that, Chuck. How do you determine the distance from 104 to, yeah, there you go. Okay. So I'm just saying that this strike needs to, I guess a good way to say it would be, and see, I'm struggling with this because I'm trying not to use terminology that I have not defined, but I can tell this is a very advanced crowd, and it's my first time talking to Options Play crowd, is if I'm doing this, I want to be I want to be somewhere in the middle of a one standard deviation move. All right, I said it. I brought up a term that I didn't introduce on this trade, but I want to be right in the middle of a one standard deviation move. It's very plausible that it could get there. I mean, I guess we could use it with delta, right? So you're targeting 30 to 35 delta put, somewhere in there as my short strike. That's about where I'd be because I'm out of the money, and that would be the same on the call side of things. So something that has a high probability or high chance of happening if you get the direction right. Okay, how do you pick strikes? Do you have to select one deep into money? Well, I think I got the strike thing. Width, I guess we're going to say 5% is the width that we want to go based off of the underlying, and that's going to get adjusted based off of volatility a little bit, okay? Volatility will greatly affect the butterfly. You want volatility to be high when you put the trade on, and then you want it to go lower. So ideally, if you're doing skip strike butterflies, it's better to do them on the call side of things, right? Because here, if the market goes down, implied volatility goes up, so you don't get paid as quickly. If I flip the script here and we're going to the opposite direction, we can do that actually. See, we flipped the script there. So now in this instance, now if the market comes up, implied volatility goes down. So I'm more apt to do a skip strike butterfly with calls if I'm neutral to bearish. But I would do it on the put side too, because there's a lot of benefits. If you were willing to sell a short put spread, if you're willing, to sell a bull put spread or a short put spread, it's still an alternative. You just won't receive, you just don't have the chance to make as much if the market comes down quickly and implied volatility goes up. All right, and then if we start here, so to start with, if you put this trade on, you have a lot of risk, and this is showing you what this is in here. I'm going to adjust this graph, but we're going 4 days out. So to start with, if the market comes up and hits your short strike, there's a very good chance that you are not profitable if it happens right away. But ultimately what happens is it starts to move back up, and that's the way the profit and loss graph looks at the end. So it's a very odd trade, but you're already putting your hedge in. You're just taking a little bit less credit up front to already have protection on your short spreads. Can you use this trade on European stock exchanges? I've never traded on a European stock exchange, but if they trade options, I don't know why you couldn't. Francis asking about an SPX. Yeah, let's put it this way. That's a 5,700 point index. I would probably go 20 points wide, maybe 25. And on the SPX, and you do 7 DTs, right? Because you have daily expirations. You can actually make it 7 instead of 8 overall. All right, how do you build a butterfly and why? Okay, I think I'm addressing most of these questions. $5 days, concerned about being assigned. Yeah, there's a chance to be assigned, but most of these underlyings, especially the expensive underlyings, there's so much time premium in the option contracts until expiration happens that getting an early assignment is a low probability. But I understand your concern. I get that. And it's really all about if the option contracts have time premium in them, which higher priced option underlyings do, then yeah, that's where we're at. Then the chance of assignment is very low. All right, I think that we are there. Okay, so here's the free trial. Please check it out. I would love you to just check out everything that's involved, all the research that's inside the Options Play platform. feel free to do that. We're way over, so I'm just going to leave it at that. Yeah, we're stayed longer than we're accustomed to. Thank you for sticking around. It looks like a lot of people stuck around, so there's still almost as many here that started. We will send the slides out. I think I answered all your questions, but I will stop sharing my screen. And if you want to look at my ugly mug, which I forgot to turn up my air conditioner, so I'm a little sweaty right now. But once again, it's my first rodeo, so I'll get the air conditioner on the next time around. Any questions that you want? I think we addressed most of them. If I missed something, I'll give you one last chance. And if not, great rodeo. Thank you, David. And I appreciate all the nice comments. Thanks, everyone. All right, please sign up for the Options Play trial. 2 weeks. Please feel free to do that. It's worth doing, trust me. And I'm going to be back. Look for the next event, because what I'm going to do is, a lot of people were asking about the risk and when I want to get out of the trade. I'm going to give you an adjustment on the trade, and then that adjustment is what I would be more apt to do than try to close it out and salvage half of the premium of the butterfly that I was trading. So thanks for stopping, and we will see you, well, in a couple weeks is the next time I'm going to be back looking at adjustments to butterflies. Thanks for coming in. Thanks for all the great comments, everyone. We'll see you soon.